Unemployment just hit 4.4%, and if you think that's a normal number, you might want to sit down. Because every time this number has crossed this zone in the past, something big has followed, and almost nobody realizes what it actually signals until it's too late. In this video, you're going to understand exactly what 4.4% unemployment really means for the economy, why this level is historically dangerous, and whether it's pointing to a market crash that could hit far sooner than anyone expects. By the end, you'll be able to read this number the same way professional investors do, as a warning, a map, and a countdown. Because here's the part almost no one talks about. Recessions rarely begin when unemployment is high. They begin when it starts rising slowly, quietly, then suddenly all at once. The market doesn't panic when the economy collapses. It panics when the trend begins. And 4.4% is the zone where that trend has flipped before every major downturn of the last 30 years. The danger isn't the number itself, it's what the number precedes. Here's what we're breaking down step by step. The historical unemployment thresholds that signaled every modern recession. Why markets react before the public feels the slowdown. And the key indicators that reveal whether 4.4% is harmless or the first tremor of something bigger. But there's one pattern hidden inside unemployment data, a pattern most investors completely overlook, that has predicted every major bear market with shocking accuracy. And before we go deeper, you need to see exactly how this pattern forms. Because once you spot it, you'll never look at unemployment the same way again.
The U.S. unemployment rate just hit 4.4%. Every time this has happened, investors faced one of two outcomes. Either the market crashed, or it exploded into one of history's strongest bull runs. So, is 4.4% unemployment a buy signal or a sell warning for stocks? Historically, the U.S. unemployment rate has fluctuated significantly, from 1% during World War I to 25% during the Great Depression. Recent data shows the rate climbing to 4.3% in August 2025, signaling a potentially weakening job market. Because what this number really means might surprise you.
When people hear unemployment is rising, their first instinct is to think that's bad news. It signals potential economic downturn. Fewer jobs, less spending, a weaker economy. These are the typical consequences. The cycle reinforces negative perceptions. But here's what most people don't realize. The stock market doesn't move on the news itself. It's more about future projections. It moves on expectations. Anticipation of future economic conditions drives market behavior. And that's exactly why some of the strongest rallies in history have started right after unemployment peaked. Markets look ahead. It sounds backwards, doesn't it? Counterintuitive, but that's often how markets operate. But in markets, what feels wrong is often what works. Understanding this paradox is key to investing.
Let's go back to March 2009, a truly pivotal moment in recent financial history, marked by significant economic turmoil and uncertainty across global markets. During this period, unemployment was climbing at an alarming rate, sitting around 4.4% and rising steadily, signaling deep and widespread economic distress throughout the nation. The headlines of the day were brutal and relentless, screaming phrases like financial collapse and end of capitalism, painting an incredibly grim and foreboding picture for the future of the economy. Investors across the board were terrified, gripped by widespread panic and an overwhelming sense of uncertainty regarding their portfolios and the stability of financial institutions. In this climate of fear, everyone wanted cash, seeking liquidity and security above all else, as traditional investments seemed to offer little comfort or safety. Consequently, everyone wanted safety, leading to a mass retreat from volatile assets and a flight to perceived safe havens, further exacerbating market instability. No one wanted to take on any risk, as the market seemed to offer only downside potential, with fears of further losses dominating investment decisions. But then, what happened next? Contrary to widespread fears and predictions, the market didn't collapse entirely as many had anticipated. Instead, it began a remarkable recovery, doubling in value in the years that followed, thereby defying all expectations and predictions of impending doom and economic ruin. Those who sold their assets in fear during this period missed out on one of the greatest wealth transfers in modern history, a truly significant and unprecedented opportunity for substantial growth and financial gain. Now, let's fast forward to 2020, another period characterized by unprecedented economic upheaval and global disruption, primarily due to the onset of the pandemic. Unemployment exploded during the pandemic, reaching historic highs as countless businesses shuttered their doors, leading to widespread job losses and economic hardship. Headlines once again began to scream recession and declare the bull market is over, echoing the despair and dire predictions that were so prevalent in 2009. And yet, despite the grim outlook, just months later, stocks began another historic run, surprising many analysts and investors who had predicted a prolonged downturn. It was the same pervasive fear, the same recognizable pattern of market behavior, just unfolding in a different year and under different circumstances. Every time unemployment spikes significantly, people tend to panic, reacting instinctively and emotionally to the profound economic uncertainty that such events bring. But almost every single time, that very panic becomes the unexpected foundation for the next recovery, effectively setting the stage for future growth and market resurgence. Understanding this profound historical correlation can provide invaluable insights for both seasoned investors and market learners alike, helping them navigate future economic cycles with greater foresight and confidence. So, why the market opportunity?
Here's what most people completely miss about the financial markets and how true wealth is built. By the time you hear the headlines screaming about economic downturns or market crashes, the smartest money on Wall Street has already made its move. They're not reacting to bad news with panic. Instead, they are strategically using it to their advantage, understanding the deeper implications. Consider a scenario where unemployment begins to rise. While this might trigger widespread concern, seasoned investors recognize it as a precursor to specific governmental actions. They anticipate that the Federal Reserve will eventually intervene, implementing measures like cutting interest rates and injecting liquidity into the financial system. These actions are designed to stabilize the economy and, crucially, set the stage for the next significant wave of growth and market recovery. While the average investor might freeze, paralyzed by fear and uncertainty, large institutions are quietly and methodically positioning their portfolios for the inevitable upturn. They interpret a 4.4% unemployment rate not as a cause for panic, but as a clear signal, an indicator of future market shifts. This is because the market operates on anticipation. It doesn't wait for the economy to feel robust and healthy before it begins its ascent. That's precisely why stocks often start to rise, sometimes quite dramatically, even when the world still feels deeply uncertain and headlines are overwhelmingly negative. The market moves first, driven by forward-looking analysis and strategic positioning, while the general public and the headlines only catch up much later. Fear, though powerful, ultimately creates only short-term noise and distractions in the investment landscape. It can lead to impulsive decisions that undermine long-term financial goals, clouding judgment with immediate anxieties. In contrast, patience, combined with a clear understanding of market cycles and economic indicators, is the true architect of long-term wealth. It allows investors to ride out temporary volatility and capitalize on opportunities that others miss, transforming perceived risks into significant gains. By shifting your perspective from reactive to strategic, you can learn to see beyond the headlines and identify the hidden opportunities that fear often obscures. Embrace the long view, understand the signals, and let patience guide your investment journey towards lasting prosperity.
So, with